Imagine waking up and realizing your money has been growing while you were sleeping, not because you worked more, but because it was invested wisely. That's the reality for millions of investors worldwide. And the truth is, you don't have to be rich, you don't have to be a math genius, and you don't have to take huge risks to start. In this course, I'm going to take you step by step from absolute beginner to confident investor, so you can finally make your money work for you. This is a complete beginner's crash course to investing in the stock market. You'll learn what a stock actually is, how the stock market works, how to open your first account, how to choose your first investments, and how to build a plan that fits your budget, whether that's $10 a day or $200 a month. Everything is explained in simple, everyday language, with real-life examples you can relate to. By the time you finish this course, you'll know how to invest with as little as a few dollars a day, how to pick strong companies without being glued to a screen all day, how to manage risk so you protect your money, and how to stay consistent so your wealth grows year after year. We'll break everything down into practical, actionable steps you can follow right away. So, get comfortable, grab a notebook, and let's dive in. Lesson 1 is waiting for you, and it might just change the way you think about money forever. Lesson 1. Stock Market Basics for Beginners. What it is and how it works. Let me start with a question. If you could own a tiny slice of your favorite company, maybe Apple, Coca-Cola, or Netflix, and get paid whenever they make money, would you take that deal? That's exactly what the stock market allows you to do. It's one of the simplest and most powerful tools for growing your wealth, and it's been working for ordinary people for over 100 years. In today's first lesson, even if you've never heard of stocks before, don't worry. By the end, you'll know what a stock is, how the market works, and why it even exists. All right. First things first, what is a stock? Think of a company like a giant pizza. A stock is basically a single slice of that pizza. When you buy a stock, you're buying a piece of that pizza, a small part of the whole company. Let's make it more real. Imagine your friend owns a bakery. Business is booming. The cupcakes sell out every morning, but they need $10,000 to buy a new oven. Instead of taking a bank loan, your friend decides to sell 10 shares of the bakery for $1,000 each. If you buy one share, you now own 10% of the bakery. That means when the bakery makes profits, you get 10% of them. Now, instead of your friend, imagine the bakery is Coca-Cola. Instead of 10 shares, they sell billions of shares. And instead of selling them to neighbors, they sell them to the public, to people like you, through something called the stock market. Here's the beautiful part. Owning just one share makes you an owner. Sure, you might own 0.00001% of the company, but that still makes you part of its story. If the company grows, your share's value grows too. Now let's talk about the big stage, the stock market itself. Picture the stock market like a giant online shopping mall. But instead of buying shoes, electronics, or home appliances, people are buying and selling pieces of companies. Here's how the flow works. 1. Companies list their shares on the market through something called an IPO, initial public offering. We'll talk more about that in a later lesson. 2. Investors buy and sell shares every day. 3. Prices change based on supply and demand. Just like a concert ticket price shoots up when everyone wants it, stock prices go up when more people want to buy than sell. Let's say Tesla's stock is $200 today. Tomorrow, Elon Musk announces a breakthrough battery that lasts 10 times longer than any competitor. Suddenly, millions of people want Tesla shares. That demand pushes the price up, maybe to $210 or $220 in a single day. On the other hand, if bad news hits, say a major lawsuit or a poor earnings report, people might rush to sell. More sellers than buyers means the price falls, maybe to $190 or $180. So, why do we even have a stock market? It exists for two main reasons. For companies, it's a way to raise money for growth. Instead of taking a loan with interest, they sell ownership pieces to investors. That money might help them launch new products, open new branches, or expand internationally. For investors like you and me, it's a way to share in the success of businesses we believe in and build wealth over time. It's a win-win. Companies get the funding they need, and investors get the opportunity to grow their money, sometimes dramatically, over years or even decades. If you've ever seen a skyscraper in your city, a blockbuster film, or a revolutionary gadget, chances are the stock market played a part in funding it. Now you understand what a stock is, how the stock market works, and why it exists. But here's the next question. What should you invest in when you're starting out? That's exactly what we'll cover in Lesson 2, Types of Investments for Beginners. Trust me, once you see the variety of ways you can invest, the stock market will start to feel a lot less intimidating and a lot more exciting. Lesson 2, Where to Invest in the Stock Market for Beginners. Last time, we learned what a stock is and how the stock market works. So now you know it's not a casino, and you're probably already imagining which company's slice of pizza you'd like to own. In this lesson, we're going to explore the main types of investments: stocks, ETFs, mutual funds, and bonds, so you know exactly what's on the menu before you start ordering. Before we get into the types, let's talk about why we need options in the first place. Imagine you own a fruit shop and all you sell is mangoes. Business is booming until a bad season hits and mango prices crash. You're stuck. But if you also sell apples, bananas, and oranges, you've got backup. That's what diversification is in investing, not putting all your money in one place. Different investment types behave differently in different market conditions, so by mixing them, you reduce your overall risk while still having the potential for growth. Let's start with the star of the show, individual stocks. We covered the basics in Lesson 1, but here's a quick refresher. When you buy a stock, you own a piece of a company. If that company grows and becomes more valuable, so does your piece. For example, if you bought Apple stock back in 2010, when the iPhone 4 was hot, you'd have seen your money grow a lot. But here's the thing, picking the right stock isn't always easy. If you guessed wrong, like buying shares of Blockbuster in 2005 thinking DVDs were forever, well, you know how that story ends. ETFs, or exchange-traded funds, are like the sampler platter at a restaurant. Instead of buying one company, you're buying a basket of companies. Example, if you buy the S&P 500 ETF, you instantly own tiny pieces of 500 different companies, from Apple to Starbucks to Costco. Why beginners love ETFs? You don't have to research individual companies. They spread your risk. If one company stumbles, others can balance it out. They're easy to buy and sell, just like stocks. Think of ETFs as a Netflix subscription for investing. You don't have to pick every movie. The platform, or in this case the fund, gives you a collection. Mutual funds. A mutual fund is like a big money pool where lots of people put in their money and a professional manager invests it for them in things like stocks, bonds, or both. It's perfect for people who don't want to research and pick investments themselves. For example, imagine 100 people each put $1,000 into the same jar. That's $100,000 total. The manager takes that money and invests in a variety of companies. If those companies do well, everyone's share grows. There are many benefits of investing in mutual funds. Beginner-friendly. No need to choose investments yourself. Diversification. Your money is spread across many companies. Hands-off investing. The manager does all the work while you watching your money grows. Bonds. A bond is basically a loan you give to a company or the government. They promise to pay you back later with interest. Example, if you buy a $1,000 bond with 5% interest for 1 year, You'll get your $1,000 back plus $50 in interest after a year. Bonds comes with lower risk than stocks, so less chance of losing your money. They give you a good for balance in a portfolio, especially during stock market drops. Government bonds are among the safest investments on earth. So today we've seen that there's more to investing than just buying one company's stock. You have stocks, mutual funds, ETFs, and bonds, each with its pros and cons. In the next lesson, we'll talk about opening your first investment account, how to actually start, what documents you need, and how to avoid beginner mistakes when signing up. Lesson 3. How to create your first brokerage account. So far, we've learned what investing is and the types of investments you can make. Now, it's time to take action. In this lesson, I'll walk you through opening your very own starting point for investing, your brokerage account. Think of this as the passport you need for your investing journey. You're going to be guided like a friend, step by step. So, which platform to use to start investing in stock market? There are so many investing platforms out there, but if you're just starting out, you want 3 things: simplicity, low cost, and trustworthiness. Here are a few top picks for beginners: Robinhood, Fidelity, E-Trade, Vanguard. They all are perfect if you want quick and beginner-friendly platforms. Here are a few advantages of these platforms. They take 0 commissions, 0 account minimum, and easy-to-use interface. Tons of educational resources, solid research tools, and fractional shares. Shares, ETFs, crypto, and even IPOs available. Let's explore how to sign up for your brokerage account. For example, we are opening on Robinhood. Download the app or visit their website and tap Sign Up. Enter your personal info: name, date of birth, U.S. address, phone number, and your social security number. Robinhood needs this to verify identity. Answer a short questionnaire about your employment and investing experience. It's law, not a test. Verify your identity by uploading your ID, driver's license, or passport. You can just take a quick photo of it from your phone. Link your bank account via a secure system like Plaid. You can start with as little as $1. Submit and wait for approval. Many people get approved in minutes. Others might take up to 1 day. When your account is live, you're officially ready to start investing. We'll cover what to do next in the next lesson. So, big moment done. You've chosen a beginner-friendly platform and opened your first investing account. Congratulations, you're officially in the game. In the next lesson, we're going to walk through how to select your first investments and which stocks to buy. So, stay tuned. Lesson 4. How to pick the best stocks. Today, we're stepping into the part everyone gets excited about, and sometimes nervous about: choosing what to buy. Now, I know what you're thinking. There are literally thousands of stocks and funds. How do I pick the right one? By the end of this video, you'll know exactly how a beginner can pick investments that actually make sense, without feeling overwhelmed or guessing randomly. Before we dive in, let's do a quick refresher on your main options. Individual stocks, buying a slice of a single company, high potential but more risk. ETFs, exchange-traded funds. Think of these as baskets of stocks. Great for beginners because they spread your money across dozens or hundreds of companies. Mutual funds, professionally managed collections of stocks or bonds, perfect for hands-off investors. Index funds, a type of ETF or mutual fund that tracks the overall market, super low cost and reliable for long-term growth. Now, this is the part beginners often struggle with: actually picking what to buy. Let's make it practical. Step 1. Look for companies with a strong history. Check how long they've been around. Have they survived recessions? Do they have consistent profits? Example: Apple, Coca-Cola, Johnson & Johnson. They've been around for decades, kept innovating, and survived market ups and downs. Step 2. Check growth potential. Look at revenue and earnings growth over the past 5 to 10 years. Are they expanding into new markets? Example: Amazon grew from online books to dominating e-commerce and cloud computing. Seeing trends like this helps you pick companies likely to grow. Step 3. Track the news and company updates. Read financial news, quarterly reports, and press releases. Example: Tesla might have a great product, but if production is slowing or there are regulatory issues, the stock could be volatile. Step 4. Look for a competitive advantage. Does the company have something unique, brand loyalty, patents, or exclusive tech? Example: Coca-Cola has brand recognition that's almost impossible to beat, which makes it a stable choice for dividends. Step 5. Use simple metrics. Revenue growth, profit margins, and debt levels give you a quick sense of health. You don't need to be a finance expert, just notice trends. Example: a company whose profits are steadily growing year over year is generally safer than one with huge swings. Step 6. Start small and test. Buy a few shares or a small ETF position. Watch how it performs. Adjust as you learn. Example: Jake buys $50 in an S&P 500 ETF and $50 in a tech ETF. Over 6 months, he sees how the market moves and gains confidence before adding more. Step 7. Diversify wisely. Don't put all your money in one sector. Spread across industries, tech, consumer goods, healthcare, so one bad day doesn't wreck your portfolio. The key here is research, patience, and starting small. Even beginners can make smart choices if they follow these steps. Before we finish, let's quickly cover some beginner mistakes to avoid. 1. Chasing hot tips or social media hype. Just because someone online says a stock will 10x doesn't mean it's true. Always research before buying. 2. Putting all your money in one stock. Even if it looks amazing, don't risk everything on a single company. Diversify to reduce risk. 3. Ignoring company news or fundamentals. Check earnings, growth, and important updates. Blind investing can lead to big losses. Keep these in mind, and you'll save yourself stress and protect your money while building your investing habits. Congratulations! You now know how to pick investments that match your goals. Next time, we're going to create your very first investment plan, including a small daily investment strategy that can grow into a serious passive income stream. You won't want to miss it. Lesson 5. How to create an investment plan using the power of compounding. Let me ask you something. If you had the choice between getting $1 million today or just 1 penny that doubles every day for 30 days, which would you pick? Most people would grab the million instantly. But the crazy part, that little penny would actually turn into over $5 million after 30 days. That's the power of compounding. And today, I'm going to show you how to use it in your investing plan to completely change your financial future. Here's the truth. Most beginners fail at investing not because the stock market is bad, but because they don't have a plan. Think of it like going to the gym. If you walk in and just randomly use machines without any idea of what you're working on, you won't see results. But if you follow a structured plan, even just 30 minutes a day, over time your body transforms. Investing works the same way. Even if you only have $5 or $10 a day, with the right plan, you can build wealth that shocks you in the future. Okay, let's make this real. Imagine you invest just $10 a day. That's $300 a month. Not a huge amount. It's about the cost of a Netflix subscription, a few coffees, and some snacks. Now, let's say you put that money into an index fund like the S&P 500, which historically returns about 10% a year on average. Here's how it plays out. After 1 year, you've put in $3,650. With growth, you're around $4,000. After 5 years, you've put in $18,250. but your account could be worth $23,000 to $25,000. After 10 years, your $36,500 invested could grow to about $58,000 to $60,000. After 20 years, you've put in $73,000, but it could compound into around $190,000. After 30 years, your $108,000 invested could grow to almost $600,000. So you didn't need a huge salary or a lottery ticket. You just needed time and consistency. That's why compounding is called the eighth wonder of the world. It turns ordinary people into millionaires over time. Now let's talk about how this works for different people. If you're a student, you might only be able to put away $50 to $100 a month. That's okay. You're young, and time is your greatest asset. Even small amounts, if started early, grow into something huge. If you're a working professional, maybe you earn a steady salary and want passive income. You can put aside $300 to $500 a month into ETFs or index funds. Over time, these investments can generate dividends, which are like bonus paychecks from companies you own. If you're close to retirement, you'll want safer investments, maybe dividend-paying stocks or bond funds. Your focus isn't just growth anymore, but steady income. Compounding still helps you, but the priority is protection. So no matter who you are, student, professional, or retiree, there's a way to build an investing plan that works for your life. Here's the part most beginners don't want to hear. Consistency beats everything. It doesn't matter if you invest in the perfect stock one time. What matters is that you keep investing regularly, even when the market looks scary. Think of it like planting trees. If you plant one tree, it's nice, but you won't have a forest. But if you plant a small tree every month, in 10 to 20 years, you'll have shade, fruit, and wood for life. Your money works the same way. Each investment you make is like planting another tree. Compounding makes them grow into a forest. Let me give you a quick challenge. If you invest just $5 a day, that's 1 cup of coffee. After 30 years, you could end up with about $300,000. If you invest $10 a day, it jumps to nearly $600,000. If you push it to $20 a day, we're talking over $1 million. That's the difference consistency and compounding make. So, here's the takeaway. You don't need to be rich to start investing. What you need is a plan and the patience to let compounding do the heavy lifting. Start with what you can. $5, $10, $20 a day. Plant those seeds. Stay consistent and give it time, because one day, 20 or 30 years from now, you'll look back and thank yourself for starting today. Lesson 6. Risk management, diversification, and the hidden costs of investing. Most beginners only focus on how much money they can make. But the truth is, what really matters is how much money you can keep. Because if you don't manage risk, diversify your investments, and pay attention to taxes and fees, compounding won't work in your favor. In this lesson, I'll show you how these silent killers affect your wealth using real-life examples and numbers. Let's start with risk. If you had invested $10,000 in Amazon at the peak of 1999 during the dot-com bubble, by late 2001, that $10,000 was worth just $1,300. That's an 87% crash. But if you held on and stayed diversified, today Amazon stock has grown over 200 times since its IPO. The problem is, most people couldn't handle the crash and sold. That's why risk management is about protecting yourself from situations where you panic and sell low. The market will always go up and down, but if you're diversified and think long-term, you can ride out those storms. Here's how diversification saves you. In 2022, Netflix stock fell over 50% in a single year. If you had only invested in Netflix, that's a disaster. But if you owned the S&P 500 index, which includes 500 companies, yes, Netflix dragged you down a little, but energy stocks like ExxonMobil and Chevron went up almost 60% that same year, balancing things out. So your portfolio didn't collapse, it smoothed out the ups and downs. That's the magic of diversification. You don't need to pick the winner. You just need to avoid betting everything on one loser. Now let's talk about taxes. Suppose you invested $10,000 and sold it after 1 year for $12,000. That's a $2,000 profit. In the US, if it's a short-term gain, it's taxed like income, maybe 25%. That's $500 gone in taxes, so you only keep $1,500. But if you held it for more than a year, your tax rate could drop to 15%. Now you only pay $300 in taxes, keeping $1,700. That's $200 more, just for being patient. And if you keep reinvesting without selling, your money compounds before taxes. That's why long-term investing is so powerful. So, here's the golden rule of smart investing. Manage your risk. Don't bet the farm on one stock. Diversify your portfolio so winners balance out losers. Keep investments long-term to reduce taxes. Always choose low fees, so compounding works for you, not against you. Because building wealth isn't just about how much you make, it's about how much you keep. That's the secret that separates rich investors from broke ones. Congratulations! You've just completed this beginner investing course. Most people never take the time to understand how money really works, but you did. That already puts you ahead of 90% of people out there. Now here's the truth. Knowledge alone won't change your life. Action will. Even if you start small, what matters is that you start. Your first investment, whether it's $10, $50, or $500, is the first step towards financial freedom. Don't wait for the perfect time. The perfect time is today. Thank you for watching, and I wish you the best on your investing journey. This is just the beginning. Your future self will thank you for the steps you take today.